Hello, and welcome to the third episode of Capital Markets Live. I'm Alvin Lam, Managing Director of International Markets at Ginnie Mae. And today I'm joined by Jay Beckow, Managing Director and Co-Head of U.S. Securitized Product Research at Morgan Stanley. He is currently Institutional Investors' first overall rank analyst in agency RMBS and agency CMO and derivatives categories. In this episode, we would like to discuss market insights as we begin 2021. Your valuable insights into the market strategies are always timely. Jay, thank you for joining us today.
Alvin, thank you for having me. It's great to be here. I'm always happy to spend some time nerding out on the mortgage market.
Great. Let's start with the big picture. Home ownership is a high priority for the president and secretary. The pandemic is affecting many homeowners and their ability to pay mortgages. Ginnie Mae has issued a series of policy tools to support homeowners and regulate the mortgage market in the past 10 months. What do you see as challenges in the next 3 to 6 months for Ginnie Mae?
The forbearance program's modifications and partial claims that have been announced should definitely ease the likelihood of defaults as borrowers exit forbearance. We would like to thank Ginnie Mae for being as transparent as they are about when the forbearance contracts expire, for instance, and we know that there's going to be a bit of front loading of the forbearance expiration in the spring. Now, while we have seen solid performance in borrowers who have exited forbearance already, we are worried about the negative survivorship bias for the performance of borrowers that stay in forbearance for the entire period. The recent announcement of forbearance extension beyond 12 months has certainly helped and will help the performance of the borrowers, but more information and more advertising to make them aware of the options would also likely help borrower performance. That being said, we will point out that the strength of the housing market in general post-COVID has been almost Herculean, as robust demand and tight supply has led to an over 10% increase in home prices year on year. Now, this has been more focused in the suburban and less dense urban areas than in dense urban populations. While the increase in home prices makes buying a home difficult, monthly principal and interest payments relative to income are near the most affordable levels of the past 5 years, due to mortgage rates, which, while have sold off somewhat, are still extremely low.
Thank you for sharing that view. What are some of the conversations you are having with MBS investors on mortgage valuations, the impact of Federal Reserve, and the deposit growth of banks?
There's a common theme here, Alvin. Given that you have the Federal Reserve committed to buying $40 billion of mortgages on a net monthly basis for the foreseeable future, it's hard for mortgages to widen too much. Now, that money getting put into the system, in conjunction with both past and upcoming fiscal stimulus, has meant that bank deposit growth has been unprecedented. 2020's deposit growth of almost $3 trillion was more than 5 times the average deposit growth in the previous 5 years. Given that there is not much demand for customers to take loans out right now, loan-to-deposit ratios are at 50-year lows. Thus, banks are investing in securities, specifically agency mortgage market. This combination of both Fed and bank demand has taken mortgage nominal spreads to near all-time tights. Investors recognize this, but are struggling with how much further room there is for spread compression, or if they should look for opportunities in other asset classes. I would say recently those conversations are getting more biased towards shifting into other asset classes.
Thank you. In your view, what are your expectations for Ginnie Mae issuance this year and Ginnie MBS value proposition?
Last year, we saw record gross issuance across both conventionals and Ginnies as a function of a healthy purchase market and all-time low mortgage rates. This year, we are forecasting further strength in the purchase market, but for mortgage rates to back up slightly from where they are now. Interestingly, while gross issuance across all agency markets was at an all-time high, net issuance in Ginnies was negative $19 billion in 2020, mostly due to buyouts of delinquent loans. We think that will revert in 2021, causing more supply in Ginnies, which could weigh on valuations going forward. Now, we think a lot of this is in the price, and currently we are recommending a tactical long on the Ginnie Fannie 2 swap, as we think valuations are compelling and it's possible that we could get a shift in regulations. Now, we will point out that risks to this trade are that the bank demand will continue to be focused in conventional mortgages, and finding a buyer of Ginnies may be challenging.
Assessment. So, Jay, what would it take, whether FSJ or Ginnie Mae, to have you move on from underweight to overweight? What type of changes to your envision?
When we think about mortgage valuations, and we don't just think about mortgage valuations in a vacuum, and it depends on what other asset classes are doing. We recently moved from underweight mortgages to neutral mortgages as the migration to a higher rate range we think should reduce the prepayment risk. If mortgages widen versus other asset classes, we could see us going overweight, or if mortgages outperform, we could see us going underweight. Now, it also depends on the strength of the bank demand, along with regulatory changes that could impact our view. For instance, we are looking at the SLR initial rule, which, if it expires in March, could change the bank demand for Ginnies going forward.
Good to hear that. What do you think will be the most important driver in the near term on the MBS market?
We think banks are probably the most important driver in the near term. We know that the Fed is going to continue to buy and originators will continue to sell. If banks are going to be investing their deposit growth into mortgages, then mortgages can continue to stay well bid. But if banks pause, the supply from the originators will likely, at least initially, outweigh Fed demand.
In your recent study piece, you discuss March of month. How does Morgan Stanley look at the loans being modified and their performance going forward? Do you see the markets receptive to the modifications and the performance 3 to 5 years down the road? How does the market pricing in the risk?
In general, mods have a flatter S-curve, as their prepay behavior is more focused towards buyouts and less towards voluntary than purchase or refi loans. We can easily see this historical tendency by looking at loan level data. But obviously, we have never seen a large-scale forbearance program like this before, so we are in slightly uncharted waters. Given this uncertainty, investors are pricing in a little more risk premium than they historically have.
Good point. Issuance of modified loans has been increasing in recent months. If modified loans continue to come from previously forborne borrowers, do you think that this could improve the profile of Ginnie multis, as Ginnie modifications are far less sensitive to refinance incentive?
The market is generally assuming this is the case. So over a long term, this should be a positive from a convexity perspective, but a negative from a supply perspective.
What do you think is important to understand how modified loans have paid at this?
Historically, modified borrowers have had a redefault risk, which is somewhat rate insensitive. The question for us on these modified loans is why borrower modified now instead of staying in forbearance. From our perspective, it's unclear why a borrower would not want to stay in forbearance as long as possible before starting to make their payments again after modification. So perhaps there's some type of selection bias around the early modified loans that will cause them to behave differently than other loans that make it all the way through forbearance.
I see. Can you review workout outcomes for Ginnie borrowers?
Of course. Now, the workout options are slightly different for FHA versus VA, let alone something like rural housing or some of the other smaller programs. But broadly speaking, assuming the borrower is in forbearance, they have an option to file a partial claim, which puts the missed payments into a separate junior lien that is repayable when the mortgage ends. This assumes that they can make their old current monthly mortgage payment, though they are eligible to refinance their mortgage immediately. If they cannot make their old payment, the next step is a modification. And if that does not work, they can try a partial claim and a modification together, though if they cannot make even the lower payment, then the next steps would be something like a short sale.
You mentioned earlier that the president extended the forbearance program. How will the end of forbearance impact future speeds and supply in Ginnies?
Simply leaving forbearance will not be a prepay event if the loan is in the pool. But our assumption is that given the increased interactions between homeowners and servicers during forbearance, many of the borrowers will refinance or get modified as they exit forbearance, which will have a bigger impact on higher coupons than lower coupons, given that forbearance is more common in higher coupons. Now, if the servicer has bought the loan out, then the prepay event has already happened for the investor. But the borrower has started to perform again will eventually result in issuance, either through the CRG program or just modified loans appearing in lower coupon multis.
Thanks. Let's looking forward future again. Can you provide some figures on the size of future issuance in reperforming and modified loans?
Sure. There have been a little less than 50 billion of buyouts post-July that could come as CRG pools, and there's about 135 billion more 90-day delinquent loans that are currently eligible to be bought out, with most of those left in Ginnie Mae 3s, 3.5s, and 4s. Of course, it's difficult to ascertain exactly how many of these buyouts will actually be converted to CRG pools or mods, or simply be refinanced and delivered into a multi instead. But that's the eligible universe that we are working with as a denominator.
Last year, amid the worst pandemic in a century, markets generally outperform expectations. How does Morgan Stanley see Ginnie Mae bond market performance in 2021?
As I mentioned earlier, right now we're recommending a tactical overweight to the Ginnie Fannie 2 swap based on attractive starting valuations and recent underperformance. And we also think that if there are changes to the SLR rule, then the bank demand function could shift, as a leverage constraint would make Ginnies look more attractive versus treasuries. Now, the risk to this trade is if supply continues to come and bank demand does not shift out of conventionals, which they've been favoring, into Ginnies. Of course, otherwise we are net neutral. Agency mortgages, as attractive technical demand from Fed and banks, is roughly equaled by heavy supply and reasonably tight valuations.
Well, it looks like that is all the time we have for today. Jay, thank you so much for your time and sharing insights.
Thank you, Alvin. It was a pleasure speaking with you today.
That was Jay Beckhoff, Managing Director in Securitized Product Strategy at Morgan Stanley. If you enjoyed this podcast, be sure to subscribe to future episodes of Capital Markets Live on YouTube. If you have any comments or questions about today's episode or other topics, please send us an email at ocmglobal.investorinquiry@hud.gov. Again, thanks for listening, and until next time, stay healthy and goodbye. This podcast was recorded February 24th, 2021.
For important disclosures, please see the Morgan Stanley disclosure website at www.morganstanley.com/disclosures. Thank you.